Starting with the Eurist chart analysis, Eurist is currently trading at approximately 1.1583, hovering directly near the 1-hour supply zone ranging from 1.1578 to 1.1595. Following a sharp sell-off throughout June and July that formed a major bottom near 1.1320 to 1.1340, the market exhibited a strong bullish recovery in August, highlighted by multiple upward break of structure, BOS, signals. The immediate resistance and supply zone sits between 1.1575 and 1.1595, serving as the current testing zone, while immediate support and demand rest between 1.1560 and 1.1570. Furthermore, higher time frame support points of interest, POIs, are located further down at 1.1500, 1.1440, and the 1.1320 to 1.1336 region, creating a clear technical roadmap for upcoming sessions. Moving on to the GER40 chart analysis, the German 40 index is currently trading around 26,123, consolidating precisely within a 1-hour demand zone between 26,050 and 26,150 right beneath previous structural impulses. After a powerful macro bullish expansion starting from the July lows around 24,100 and surging up to highs near 26,580, the index has successfully completed a healthy pullback into this current demand zone. The immediate support and demand POI is positioned at 26,050 to 26,150, acting as the primary reaction zone, while immediate resistance and supply are found between 26,480 and 26,580. Additionally, lower support POIs are established at 25,600, 25,350, and 24,600 to catch any extended downside movement and maintain overall macro structure perspective. Bringing these two markets together, an inverse correlation typically plays out between them, as a rising euro often puts pressure on German export-heavy indices like the GER40. If Eurist faces rejection at its 1.1580 to 1.1600 supply ceiling, GER40 is well positioned to respect its 26,100 demand floor and resume its upward trend toward 26,450 and beyond. Conversely, if Eurist breaks out cleanly above 1.1600 with high volume, it could trigger shifting risk sentiment that weighs heavily on German equities, making multi-market tracking essential for risk management and trade execution strategies. Today, we are conducting a top-down structural analysis of the GER40 index. If we look at our macro perspective on the weekly chart, the dominant story is an undeniable, powerful bullish trend. Over several years, the market has consistently printed higher highs and higher lows, validated by clear structural break of structure points. Notice how price pulls back into established point of interest demand zones, marked neatly in cyan, before launching upward. The macro structure remains completely intact, telling us that trend continuation strategies from higher time frame demand zones offer the highest probability for swing traders. But how does this translate to our intraday and swing setups? Let us zoom into the daily and lower time frames. Transitioning to the daily chart, we see the aggressive impulse phase accelerating upward inside a defined ascending channel. The price action showcases impulsive surges followed by shallow, orderly retracements. Each major leg up breaks prior highs, confirming that buyers remain firmly in control. However, when assets move this aggressively, we must monitor for signs of exhaustion or localized pullbacks. The recent daily candles show price testing upper structural boundaries near the 26,500 to 26,600 region. This brings us to our lower time frame execution charts where a shift might be brewing. Let us examine the 4-hour chart and the 30-minute chart. Here, we spot a fascinating tactical setup labeled alternative bearish pullback. On the M30 and H4 charts, price pushed into a major red poi supply zone near the highs around the 26,500 to 26,600 handle. Following this touch, we observe a sharp rejection accompanied by downward structural breaks, signaling a potential short-term correction. The bearish scenario indicates that if intraday momentum persists, we could see a deeper corrective pullback targeting the immediate cyan demand zone resting around 26,100 to 26,200, which aligns with major structural support. The bullish continuation scenario reminds us that because the macro trend is heavily bullish, traders should not aggressively chase shorts. Instead, watch how price reacts when it tests these lower demand zones. If lower time frames print a bullish reversal pattern or a change of character inside the 26,100 demand area, it serves as an optimal trigger to rejoin the macro upward trend. Expanding further on market mechanics, successful execution requires a deep understanding of multi-time frame correlation, liquidity sweeps, and order block validation. When the GER40 approaches historical supply barriers, retail liquidity often gets trapped above psychological round numbers, triggering swift algorithmic counter moves. Smart money participants patiently wait for these induced imbalances to clear before committing large capital blocks. By integrating volume profile metrics with traditional market structure analysis, you can effectively filter out false breakouts and avoid getting caught on the wrong side of high volatility news events. Furthermore, maintaining strict risk-to-reward parameters ensures that a series of minor intraday losses will never compromise your broader trading account stability. Always align your individual trade triggers with the dominant macro sentiment, keep a close eye on upcoming European macroeconomic data releases, and ensure your invalidation levels are mathematically sound before executing any position. Additionally, keeping a dedicated trading journal helps you track recurring patterns, refine your psychological discipline, and eliminate emotional decision-making during high-stress market fluctuations. Analyzing your past execution errors allows for continuous performance optimization. Examining the 1H GER40 chart reveals a critical transitional phase as price retests the primary institutional demand area between 26,100 and 26,200. The broader macro structure remains decisively bullish, characterized by successive break of structure events and strong impulsive displacement following the previous August rally. However, price is currently compressed near 26,123, placing participants at an inflection point where institutional footprints will dictate the next major directional expansion across global markets today. Right now, within every single major trading session to understand the upcoming price action very carefully. Our invalidation level is strictly set at approximately 26,000 for the bullish framework, whereas the bearish scenario relies on invalidation above the 26,500 to 26,600 supply zone. Professional execution requires strict adherence to risk management parameters, continuous observation of order book depth, and protection against high-impact macroeconomic volatility stemming from upcoming European data releases scheduled for this active trading session today without causing unnecessary portfolio drawdowns during unexpected market movements throughout the entire trading week. Our focus is on this entry zone. We are waiting for mitigation here. Once price action confirms, we can expect the move to start. The primary bullish roadmap assumes that 26,100 to 26,200 will absorb residual selling pressure and initiate a bullish displacement. Under this primary scenario, Scenario 1 targets liquidity clearance at 26,300 to 26,400, followed by Scenario 2 targeting the major supply barrier at 26,500 to 26,600. A decisive acceptance above this supply threshold opens the structural pathway towards Scenario 3 at 26,800 to 27,000 very clearly here right now across all execution. Conversely, the alternative bearish framework activates if the immediate demand fails to defend. A structural breach below 26,000 via a clear 1H break of structure would invalidate the immediate continuation thesis. Under this alternative distribution model, Scenario 1 targets the secondary demand at 25,550 to 25,650, Scenario 2 extends downward to 25,300 to 25,400, and the extended liquidity void points toward the deep structural floor at 24,550 to 24,650 without any hesitation whatsoever today during volatile active. Always maintain strict psychological discipline, evaluate market liquidity parameters carefully before capital deployment, and ensure your position sizing aligns perfectly with your overall account preservation model while tracking macroeconomic shifts and ongoing institutional order flow dynamics across every session to completely eliminate impulsive trading decisions forever now during your personal trading. To summarize, GER40 is at a critical crossroads. While the weekly and daily charts shout to buy the dip, the 30-minute and 4-hour charts indicate an active short-term pullback from supply. Always wait for confirmation at your poise, manage your risk tightly, and never trade without a defined stop loss. Professional traders must remain exceptionally patient during these transitional phases, continuously monitoring order book depth and volume anomalies to avoid executing premature entries before institutional setups fully confirm. If you found this breakdown helpful, hit that like button, subscribe, and drop a comment below on whether you are buying the dip or shorting the pullback. Trade safe, and see you in the next analysis.